Hi there. As we move into a season where refinancing might become more likely, I want to make sure that as an advisor, you completely understand how we analyze a refinance. And I really believe that there's sort of three break evens that should be looked at. And just this will be a very short education piece on kind of how they work and how we look at it. It may help you think about it and how you frame the conversation with your own clients. Right. So you have cash flow, economic, and wealth break even. So I'll kind of touch very briefly on each one of them. We're not going to do a full case study here, but this is a refinance for a client, $858,000 mortgage amount, 7.375. They're dropping down to six and a quarter. You'll see right here, there's different savings. $619 a month is the monthly savings. There's upfront cost. You have principal speed here as well. And then over here are the break even scenarios. You've got cash flow break even, economic break even, and wealth break even. You can see each one's a different number, 2.5, 12, and 12.1, and 10.2 months. So I'll quickly explain what these are. So cash flow break even is what kind of most people kind of look at, right? And this can be fine, but it doesn't tell the whole picture, right? So it's really just closing costs divided by the monthly cash flow reduction. How many months does it kind of take break even? And it focuses on cash flow and what the borrower feels like in their checking account. So that's good, but it doesn't, again, tell the whole picture. In this case, it's 2.5 months. Now let's talk about sort of the next one, which is the economic break even. So the economic break even is how long are the closing costs are recovered through cumulative monthly savings, right? So now you have total closing costs divided by the monthly payments, right? So total closing costs, including what might be done to adjust the loan amount over time, as well, right? So this is how kind of we look at it, kind of traditionally as well. So we've got $3,000 in cost divided by $3,000 in savings is 10 months in this example. So in our scenario, the economic break even is 12.1 months. So again, about a year, but a lot different than 2 months. And then we look at really wealth break even, and this is one where I think that advisors really need to understand what's going on with a refinance, right? So you have costs, you have some cash flow savings, and most people don't want to reset their mortgage. That's their biggest concern. This is how we help clients understand the benefits of potentially reducing their rate and not resetting their entire term of the mortgage, right? So now we're talking about cost divided by the monthly interest savings from a lower rate plus principal acceleration really is wealth break even. So now we bring the principal acceleration back into it. And sometimes this is slowest of all three, but in this case, it's 10.2 months, right? So just a different way of thinking about it in a really critical way. And this is not going to answer the question of what they should do with that cash flow, right? If they should invest it or if they should put it back into the mortgage. But it shows that that's what a good outcome could be is 10.2 months. So this is just a quick, way of looking at it. Fastest, medium, comprehensive wealth, right? And so you're increasing wealth over here and so forth. So kind of cool. We'd love to talk to you more about it. We'll be doing some more classes around this. We have a great new suite of calculators. If you're interested in getting it, you can scan that QR code here. But hopefully I'll be talking about that here over the next couple of months as we get more and more out there. They're really great planning calculators to really help you with the liability side of the balance sheet, which is, of course, what we want to do for you. So thanks very much, and we hope to talk to you soon.